Now, you've been predicting a downturn since 2007. We've been talking about this for a long time. Where are we in the cycle here with all the bad news coming through?
Well, we got the downturn in 2008, Susan, and we haven't got out of it. The fact that we've had a couple of years of so-called recovery is on the back of the biggest monetary and fiscal stimulus programs in history. And if you strip them out, we're still actually where we were in 2008, deep recession.
Now, you said to me back in 2008, this trudging around this credit crisis will take about 4 to 5 years to get out of. Are we close to seeing the tunnel, the light at the end of the tunnel yet?
Well, it would have taken about 4 or 5 years if they had let the economies heal themselves and stayed out of the picture instead of propping up big banks, propping up auto industries in the US, etc., etc. When we wrote our end-year strategy report last year, we said that we're now worse placed than we were in 2008.
We're no worse than where we were?
We're now worse.
Are we any better?
No, worse than where we were.
We are worse.
Correct.
Than where we were in 2008.
Because of the policies that governments and central banks have followed. I mean, these zero interest rate policies of the central banks are disastrous.
Right.
They signal to producers that there's no growth coming. That's what zero interest rates tells them. It tells them that the economy is very sick and is unlikely to get better anytime soon.
Dr. Jim, I respect your views. 2008, though, we saw a big banking crisis. I mean, Lehman's collapsed and basically took down, well, almost took down the financial sector with it. I wouldn't say that we have a recurrence of that here in 2011.
We don't have a recurrence yet, but bear in mind that we've still got ongoing European problems. And I think European banks are very close to the kinds of problems that Lehman suffered from in 2008 and could possibly go under in some instances. They'll certainly be nationalised.
Right. So are you saying then that what we see in Europe could be the Lehman event for this year? Yeah.
Whether it will actually be a failure, it's unlike the Europeans to allow things to fail. So I think it's probably just going to be a series of nationalisations. As it becomes very clear that it's not really just a sovereign debt problem in Europe, it's a banking sector problem. They're the ones who were financing the sovereigns, and the sovereigns, especially places like Greece, have to default.
Now, what do you think will be the pinnacle of this European sovereign debt crisis? Are we going to see Italy be the next to need a bailout, Spain's going to fall?
Well, Spain's in deep trouble, and it's actually as much the private sector in Spain as it is the public sector there. But the pinnacle is going to be the breakup of the euro, as we know it just now. That currency just can't hold together, given the disparate nature of the economies that are within the single currency.
How long do you think that will take?
Well, it's getting quicker. The markets are on to the end game now. Usually when markets see the lamb for the slaughter sitting there, they don't stop until it's well and truly dead.
Let's pick up more on the telltale signs that you're seeing right now in the Eurozone.
Well, things like the CDS spreads on peripheral European bonds, the 10-year treasury rates that these countries are facing. Greece is up there at 18% for a 10-year treasury. These are rates of interest that the country just can't afford, and especially as it now goes back deeper into recession, and that's going to be true for the whole of peripheral Europe. Germany is barely growing.
Right.
And if Germany isn't growing, then the rest of peripheral Europe have got nobody to export to. So they're not growing anymore. Their fiscal deficits are actually worsening rather than getting better. And given that the whole premise of the bailout programme was to be that they would only get the money if their fiscal position improved, well, their fiscal positions are deteriorating. And they can't do anything but deteriorate for as long as they're locked in that single currency.
But what about the bailout funds? I mean, isn't Greece getting another $180 billion from the Eurozone?
If they comply with the conditions of the bailout. And the problem is complying with the conditions means improving their fiscal position. But they can't do it.
But right now there's no exit. I guess there's no exit method right now or rules for someone to exit the euro.
There's never really an exit method for, if you like, a currency block like this until it happens.
Right.
And the way that it will happen is probably very similar to the way that Argentina crashed off the US dollar peg, which is they close the banks on a Friday afternoon, and when people wake up on a Monday morning, they no longer have euros in their bank account, they have drachma.
Okay, well, you predicted the financial crisis here in Asia, the Asia financial crisis in 1997. Would you say that right now the headwinds are pointing to double dip since you expect the euro to break up and the U.S. isn't really growing?
Oh, yeah, I think it's inevitable that we're in a very, very low-growth global world. Double dip, whether we actually get technical recessions in places like the U.S., we will in Europe. In places like the US, it's harder to say, but I mean, really what we're talking about is the next few years. Next few years of between 0 and 2% growth in these countries.
So do you agree with PIMCO then, Alarian, saying that we have a 3% chance of going back into recession?
No, I would say that it's 2/3.
2/3, 75% probability.
Well, 66, 75,
66.
yeah.
But pretty high probabilities.
Yeah, I think they're tending to the optimistic side.
You did forecast, quite rightly, the 2007 US downturn in your what was called apocalypse reports. How does this scenario compare to that?
Yeah, well, you know, when you look at what we were using for the apocalypse reports, which was the yield curve in the US, it's very difficult to use the yield curve anymore because of the policy moves that the US has made. Except we can proxy interest rates with the CPI, and at the moment the yield curve is more inverted than it was in 2007.
Especially with Operation Twist, when they want to basically twist up the long-term yield curve and twist down the short-term yield curve.
Right.
You know how they're going to do that?
Yeah.
Basically, they're going to replace these short-term bonds with these longer-dated maturities. So that's a big twist. What does that mean, though? Some are saying that doesn't have basically say recession in the US?
Yeah, it does indeed, but I mean really what you want to look at is the shape of the curve and whether the short end of the curve is actually higher in terms of yield than the long end, because that then signals to you that there's a problem coming. You can't quite use it the way that it's constructed at the moment, but you can proxy the short end with CPI, and it really tells you that we've got a big problem.
Yeah, Operation Twist. Is that the only sort of Fed easing that you're expecting?
Well, of course, everybody's talking about QE3 now.
John has, all the time, each and every day.
There's a lot of inflation out there that he needs to justify being able to print even more money. I don't think it's going to happen.
The word apocalyptic, I mean, Angie's covering the markets today. Not quite there, but it's certainly a sell-off.
Yeah, it's a sell-off, but I think we've got a few more days of that coming over the next few months.
I'm sorry, but what happens if we do see a QE3 action from Federal Reserve Chair Ben Bernanke, and everybody's looking forward to the Thursday comments from President Barack Obama trying to stimulate what is speculated to be an economy that's already slowing down. So what effect can that have, though, on Asia and all of that hot money moves into markets
well,
here?
I'm not sure that we should expect too much from two guys that have got it wrong so far. So, you know, what they say during the course of the next... Yeah, I think you might guess, but over the course of this week, they're not going to make any difference to what's happening in the global economy. What is there just now is already baked in the cake, and it means much, much slower growth in Asia next year.
But there have been comments that they have not done enough, and that the original QE1 and 2...
Those comments didn't come from me, by the way.
Right, but how do you address that? I mean, you come from one point of view, and then there's certainly another point of view that perhaps not enough was done, and that's why we're seeing the global slowdown.
Well, of course, in our view, what's happened is that they've done too much, and the damage that they've caused is now reaping its rewards in terms of zero growth in the employment figures in the US, effectively moving back towards recession for the US economy and probably for Europe as well. If they'd done even more, it would be even worse.
Well, can I talk to you about the zero jobs growth? Because I was talking to another economist, Dan North of Hermes this morning. He says basically if you have zero jobs growth, a stall speed growth, that's basically recession in his view.
No, of course it is. And really at this point in the supposed third year of recovery, we should be at 250,000 initial jobless claims, and even more, 300,000 a month job creation.
Right.
That's what we should
Just get back down to 6% unemployment.
Well, yeah, and it'll take a long time to even get there.
Jim, which country in Asia is in the wind of all this bad experience in the US and Eurozone, don't forget? I mean, which one of them really will be affected the most? Some are saying Singapore because of the trade issues, some are saying maybe Thailand. Which one do you feel is going to feel the heat the most?
You know, I think Susan's hitting on it. It's really Korea and Taiwan.
You can ask me next time then.
Joining me now, Susan Reed, columnist at Bloomberg.
Yes.
But you know, they really are in the gust of the wind here, because they're pure export economies. Worst of all is that they're actually aiming at the productive sectors of the Chinese economy, and they're slowing as well. I mean, the only growth in China is coming from unproductive industries like the housing market, infrastructure, etc., etc.
But it is good growth, though, isn't it? I mean, it's not,
No, that's bad growth. You really want growth to come.
Everyone, you're saying that Chinese growth is a major concern. Some are saying 8 to 8%.
Oh, he's been saying this. Let me bring you back to since 2007. We've been talking about China
maybe
crashing.
a bit early on this one, but you know, what's happened over the last 3 or 4 years is that China has substituted unproductive growth for productive growth. This is always a bad sign. That's what the US had in the early 2000s with the housing market. Now China has got housing sector growth. Once you build a house, it doesn't produce anything for anybody. And really what you want is industries that produce things, profits in
But
particular.
it puts the dollars in the laborers, and conceivably they would have more money to spend, and with China trying to release itself from the addiction of
investment.
Exactly. So how does it build its own consumer class?
Well, the worrying thing here is that, of course, consumption is the second part of the story, really. You must produce things to be able to consume them. It's just a logical progression. Right. You can't consume anything that hasn't been produced. Right. So what you should focus on is actually production. The way you get production is to improve profitability. Profitability then increases investment. It's no bad thing to have investment. You just want the investment going to the right areas and at the right price. Then it's sustainable. That's the big problem.